Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on this afternoon's market action. About an hour to go until we close out the trading day. You're looking at the Dow off 228 points. A big reason for that is the losses that we're seeing in Disney. Disney shares off just about 8% right now following last night's disappointing earnings results. You're looking at the S&P off just about 0.1%. The Nasdaq holding on to gains in terms of the sector action leading to the downside. Utilities, energy, and real estate, the worst performers of the day. We're also seeing some selling in the regional banks. That's adding to pressure that we're seeing here play out in the broader market, Akiko.
Well, Shauna, let's get you caught up on our top story today. Investors are keeping an eye on regional banks as fears mount over the U.S. banking crisis. PacWest shares plummeting on Thursday after reports deposits fell over 9% last week. This comes days after the regional bank claimed it was not experiencing the out-of-the-ordinary deposit flows that rocked the other banks. For more on the financial sector, we are joined by David Chiaverini, Managing Director of Equity Research at Wedbush Securities. David, good to talk to you today. In some ways, it feels like we're starting to see a bit of a differentiation between the regional banks in the eyes of investors. You look at somebody like Western Alliance, who said their deposits actually increased. Their stock is up. To what extent do you think the moves we're seeing today are justified?
Yeah, so I do think that investors are making that distinction, and it's really because Western Alliance, for instance, they saw a very nice increase in their insured deposit level. It's now up to 79%. PacWest, they previously stated that it had gotten up to 75%, so that should theoretically help them, but clearly the stock price decline last week really did have an impact and saw that 10% outflows, which when you look at just their uninsured deposit level, that represented 40% of their uninsured deposit level. So it does seem like investors are kind of keying in on some of the metrics that are coming out. And it's good to see that Western Alliance is catching a little bit of a bid here and not having the same high correlation that they're seeing with PacWest. Now, PacWest, they do have the liquidity. They've got $15 billion of available liquidity relative to the $5 billion of uninsured deposits. The key issue will be, do we see insured deposits get spooked and leave the bank? Similar to when we look at First Republic, about 10% of First Republic's insured deposits actually left the bank. And of course, far more than that on the uninsured deposit side. So it does seem, I'm not surprised to see the stock take a little bit of a hit after their disclosure of, 10% outflows last week.
You're off just about 22% today. David, it's good to see you again. So here we are about 2 months later here. We've certainly seen jitters remain within the regional banking sector. What do you think this means for consolidation, and what does the timeline look like for this sector?
Yeah, so I do expect consolidation to occur, although I think that the recent kind of chaos and panic won't lead to consolidation in the here and now. Pretty much the main consolidation we'll see will be the ones that go into receivership. But looking out, 12 months, 18 months, I think some of the smaller banks are going to have to look for partners. And we refer to those banking deals as open bank deals, as opposed to, closed bank deals, which is what we've seen of the four that have failed. So the healthy banks today are probably going to hold out and wait for, really good deals through receivership before, taking the plunge and buying a bank right now. So I do expect an increase looking out 12 to 18 months.
So much of this really does come down to confidence. And right now, when you look at how these stocks are trading, it really comes down to the big banks versus the regional banks. You talk about potential consolidation. From an investor perspective, does that mean that it's better to put your money behind the big financial names or the big banks in anticipation of what's likely to happen down the line?
Yeah, it's the old look at, risk return. So some of the beaten up mid-sized banks that are likely to survive are at very attractive values here. But at the same time, the big banks are the ones that are showing much better signs of stability, have lower risk. And so you're going to see decent returns, but probably not as big of returns of some of the smaller banks that do survive and see their stock prices appreciate back to a more normalized level.
David, what's your favorite of the smaller banks, or your favorites?
Yeah, I would say New York Community Bank, NYCB. That's a good one that They participated in acquiring one of the banks that went into receivership, Signature Bank. They're expecting 20% EPS accretion. They've already had 20% tangible book value accretion. We also like M&T Bank, Regions Financial, and Fifth Third. Those we're referring to them as kind of down the fairway type of recommendations. And then one that is higher risk, higher return is Western Alliance. They've been beaten up pretty severely here. They've kind of turned the tide on their deposit outflows. With them trading at 3 times our earnings estimate, we think it's an attractive value.
Finally, David, Jamie Dimon, who's JP Morgan acquired First Republic, weighing in on this discussion about whether, in fact, short selling has really contributed to the kind of volatility we've seen in the regional banks. He says that the SEC should be looking into a potential ban. Based on the data that you have, what's your assessment on the extent of short selling that contributed to the declines that we have seen in regional banks?
Yeah, my view is that it did contribute, but I would say a lot of long-only investors have been bailing out on banks as well. And it really is the banks that have been the most vulnerable that have been targeted here. And I think the long-only investors recognize that as well and have been selling. So I don't think it's just the short selling pressure that's brought down the valuations of these banks. I think it's kind of across the board of investors. And those banks that are showing, better stability on an equity, a tangible book value basis when including the fair value marks, they're the ones that have seen better performance with their stock prices, and then vice versa, the ones that are screening poorly are the ones that have been kind of targeted. So it has contributed for sure in certain situations, but I don't think it's the sole reason that bank stocks have come under pressure.
David Chiaverini, appreciate you joining us today. Really good to hear your takes. Well, we're just getting started here on Yahoo Finance Live. Coming up, Disney CEO Bob Iger is speaking out on his company's ongoing feud with Florida Governor Ron DeSantis. We're going to break down the latest round in this battle later in the hour. Plus, we check in on the state of travel ahead of the summer season with the CEO of Hyatt Hotels. And we're joined by the CEO of Krispy Kreme to take a bite out of their most recent quarterly earnings report. All of that and much more still to come here on Yahoo Finance. We'll be right back.
The producer price index is cooling. April's print rising 2.3% on a year-over-year basis. That's the slowest annual increase that we've seen since January of 2021. So is this a sign that the Fed is slowly winning its battle on inflation? Joining us now, Jack Manley, JP Morgan Asset Management Global Market Strategist. Jack, it's great to see you again here. So I think every investor is looking at these inflation prints that we're getting, trying to gauge exactly what this means for the Fed. How do you think Powell and his team are looking at this number?
So I think the combination, Shauna, of the PPI print today, the CPI print that we got a little bit earlier, these are very good indicators for central banks right now, particularly Powell. We're seeing this story kind of unfold around the world, but of course the focus really being here in the U.S. I want to focus in on that CPI print in particular, and with that read that we got at 4.9% headline, that represents the 10th consecutive inflation read that is softer from where we were in June of last year. And one or two prints, that's not a trend. And of course, you can open up the hood and poke holes in these things, but 10 prints is a trend. And very clearly, there is a disinflationary trend that has taken hold in this economy. And I think that's exactly what Powell and the rest of the FOMC are looking for. So I'd say it's pretty good news.
So, Jack, with that said, what does that suggest on the next move for the FOMC? The expectation from the market, at least with the previous meeting or going into that, was a potential pause. The pivot has started to kind of recede to the back now. But what are we expecting later in the year?
So I don't think that the May hike was too much of a surprise. It was a little bit disappointing, frankly, from my perspective. I didn't think it needed to happen, but it wasn't too much of a surprise. Critically, though, we saw in the statement that was released alongside that rate decision some changes in the language there that kind of teed up this idea of a conditional pause happening as soon as June. So that is what my guess would be, Akiko, for what happens in June is the Fed decides that it's going to hold rates steady. Now, moving from there into the back half of this year, we know the market is looking for some pretty substantial cuts. Last I saw, futures markets pricing in around 75 to 100 basis points lower by the end of this year. The Fed's not telling us that, though. And you know what? To the Fed's credit, the market's been wrong every step along the way. So my guess is we get a pause in June, and then I don't think we really start to see cuts, at least not meaningful cuts, until sometime in 2024.
Jack, another big focus from the Fed, and we heard a little bit about this from Powell at the last meeting, was the stress that we're seeing play out within the regionals. We're seeing it once again today with PacWest. How are you looking at that stress and the implications that that could have for the broader economy?
I think it's very important when we're having conversations about the regionals to draw a very firm distinction between what's happening now and what happened back in 2008. These institutions may not always have the best risk management necessarily, but the loans that they are making are high quality loans. And in fact, the portfolios that they have are ultra high quality portfolios, treasuries, agency-backed debt. The reason you're seeing these problems is because rates have risen so quickly. Depositors are scrambling for higher rates, and these banks can't necessarily make up that difference because their high-quality portfolios have been marked down to market. All that's to say, I'm not particularly worried about the banking system right now. I think the Federal Reserve and Treasury have proven that they are willing to step in and backstop issues. FDIC as well. The large, too big to fail financial institutions have demonstrated that they'd much rather sort of help these banks out rather than allow them to go under. Now, that doesn't mean that the regionals won't face more pressure this year. I do think you're probably going to see a little bit more consolidation and certainly more volatility from an equity market perspective. But I am not worried about the health of the financial system, and it doesn't sound like Powell's too worried about it either.
So, Jack, you're not worried about the health of the financial system. From an investor perspective, though, is this a good opportunity? Could you argue that things have been oversold and maybe it's just a good time to get in?
Yeah, Akiko, that's a fair question. And honestly, I do like the valuation story right now when we're looking at financials. I also really like the net interest margin story when we're looking at financials, particularly for those larger institutions that have not had to pass on higher rates to their depositors. You get 1, 2, 3 basis points if you're lucky on a savings account, but your mortgage now is going to be north of 6%. There's a lot of money to be made there. But what I would say you have to take into consideration as an investor is whether you're looking at those regionals, the bigger banks, whether you're looking at any part of the equity market, the underlying focus has to be on quality. So you don't necessarily want to buy the index. This is very much a time for sector and even security selection.
Jack, outside of that, where else are you seeing opportunity right now? Because I think a lot of people, when they come on here, they're talking about the fact that we're likely going to trade within a certain range over the next 6 to 12 months. Are you in that camp?
I think at a high level, beta level, I think that's probably the case. I think this market's going to be choppy, and there's a very real possibility that it moves sideways, especially because multiples are a little bit richer than they probably should be, and because the earnings situation probably has not deteriorated as much as it needs to. But there are going to be pockets of opportunity in this market, and one of the things that I like to pay attention to within the sort of value or cyclical tilt that we've been more broadly applying to positioning is the energy space. I love energy right now. WTI is at $75 a barrel or so right now. I think that's too low. I think with China reopening, I think with OPEC flexing its muscles, I think with domestic energy policy not being particularly friendly towards fossil fuel companies and not necessarily incentivizing the reinvestment of any of these profits, energy prices stay higher for longer, and these companies are going to make a lot of money, and they're going to give it right back to you, the shareholder. So whether it's that story, the valuation story, I like energy in particular right now.
Where specifically in energy? Are we talking about big oil or something a little more downstream?
I'd say probably big oil, but I think the broad sector within the index looks pretty attractive, frankly.
All right, Jack Manley, always great to have you. Thanks so much for hopping on set here with us today. We hope you come back and visit us soon. All right, well, coming up with just about 40 minutes to go in the trading day, we've got 3 stocks on the move. We'll break it all down for you when we come back. It's time for our triple play. 3 stocks that we're watching in the final 40 minutes of trading. We've got Beyond Meat, Alphabet, and Peloton. Starting with my play today, that's Beyond Meat. Disappointing outlook pressuring shares today. We're looking at a loss of just about 17.5%. The weak guidance driven by uncertainty heading into the very important summer season for this company. Bernstein analyst Alexia Howard writing in a note to clients that Beyond Meat, quote, is not out of the woods yet as headwinds do remain here for the company. Their cash burn rate is still high after burning through more than $400 million last year. And Josh, this is a company you and I have talked about a number of times. Can't really catch a break, can't get into investors' good favor. We're looking at a loss of just about 60% in the last year.
Yeah, and it's interesting when you think about Beyond Meat and sort of what else can they build from a sales perspective, right? I think that was what you were seeing a lot of Wall Street analysts talk about today as far as how can they spark new sales growth in a tough environment. And it seems like a lot of people are pointing to, well, plant-based products are doing better in Europe than they are in the US. How are they going to sort of build that out? And it seems like right now there's just a lot of questions. And again, we were talking about this yesterday to make a comparison across sectors. We were talking about this with Under Armour 2 days ago, as far as companies that are trying to spark sales growth in the uncertain macro environment, whether we're talking about food or we're talking about clothes. I think it's interesting to see those kinds of conversations happening in earnings calls right now. When we're thinking about food from a broad perspective, some of these companies are doing fine, right? But when you get into a more niche category like plant-based food, Akiko, it seems like it's a little bit tougher of a picture.
Yeah, that last point you make, Josh, I think is key. I mean, Beyond Meat can do cost savings and restructure all they want, but the reality is plant-based meat sales are down in a big way, right. Double digits over the last year. And there's a number of questions on that front. Is it about inflation? Potentially. We could have consumers thinking, well, look, this is a luxury item. Maybe I don't need it. But there's also concern here that some see it as just a fad. They're not willing to invest that money in that kind of meat. There's not necessarily an appetite for it. So that, I think, is a big question for Beyond Meat moving forward. Let's move on to my pick here, and that is Alphabet. Investors are cheering on Google's new announcements related to artificial intelligence, pushing the stock to levels we haven't seen since August of last year. Now, on Wednesday, Google announced it would integrate the technology into search, as well as its workplace tools like Google Docs. Wall Street analysts generally pleased with Google's plans, but they're a bit split on whether they think it's enough to give the company an advantage over rival Microsoft. We heard Oppenheimer saying the presentations yesterday largely quelled near-term investor angst over the lack of innovation compared to Microsoft to OpenAI. Wedbush's Dan Ives saying Google is still in major catch-up mode. So guys, the question here moving into I.O. yesterday was what exactly the product would be they'd put forward. Still mixed, though, in terms of whether Google has the technology to compete with the likes of Microsoft.
Yeah, Kiko, I think overall, I was impressed by what they did announce, because the big criticism when it comes to Alphabet, when it comes to Google this year, has been that they're falling further and further behind in the AI race when you compare it to the strides that Microsoft has made specifically to over the last several months. So the fact that they did lay this out, I think, is certainly a step in the right direction. AI, though, guys, is really taking hold. I was just at the Goldman Sachs Industrial Conference yesterday, and it was the topic of almost every single fireside chat, every single interview I had there. So we talk about the future of AI, why it's so important for a company to bet on that. Obviously, it makes a heck of a lot of sense for Google, for Alphabet to play up their investment within this space.
And Alphabet has been dominant in that search space, right, too, which we've talked a lot about. That's where Microsoft wants to take this war as well, is in search. Mm-hmm. So you have to think that Alphabet is still well positioned here. It does make you wonder, though, just looking at the different street reaction you've seen over the past 24 hours, why did they have that presentation that they had in February when they maybe just weren't ready for it? It feels like when you watched yesterday, that felt like what you expected from Google in February, right? That's a Google event, and it was done really well, and people are now positive. So it feels like maybe they were a little bit behind as far as being ready for it, and ChatGPT took off quicker than maybe anyone anticipated, and so they sort of scrambled and put themselves behind here when really, in reality, I don't know if they were as far behind as it seemed in February. Yeah. But only time will tell, right?
Yeah, we'll see if they have the last laugh.
My play today is Peloton. Shares of the home fitness brand slipping as the company announced a recall for more than 2 million bikes. Now, in a joint release with the U.S. Consumer Product Safety Commission, Peloton says that the seat post can break unexpectedly during use and create a potential fall and injury risk. Now, this isn't Peloton's first run-in with the CPSC either. In 2021, Peloton recalled more than 125,000 Tread+ treadmills following a fatal treadmill accident. That incident sank shares more than 15% in one day and eventually ended up with Peloton paying a $19 million fine. But this bike recall is expected to be different as the company is providing a free replacement seat, but not a full bike refund. Remember, with the treadmills at Kiko, they were refunding full treadmills. It was a lot bigger of a deal, it seems. Our friend Simeon Siegel over at BMO Capital Markets said that he thinks this is not nearly as big of a deal as maybe the headline looks like. And I think when you think about just from an investor perspective, you're just sending people seats now. You're not taking bikes all the way back. You're not refunding it. So just from an overall cost structure aspect, it might not be as big of a deal, but I did notice on Amazon, they were not selling the bikes right now. So that will be the long-term thing to watch, is when do this is the original Peloton bike, when do those bikes go back on sale and how much does Peloton lose out on sales because of it, I think is a big question.
Yeah, Josh, the point you make on cost, I think is a good one. But to Simeon's point, it's worth putting this in context, right? So Peloton got 35 reports of unexpected breaks in the seat between January 2018 and this month, but they sold 2 million bikes during that time. So it's still a very small portion, but it goes back to what happened in 2021. This is the second thing for Peloton now. Is there a bit of question about confidence in their product and the safety? And then, of course, you go back to the earnings and the numbers that we got from the company. Things are improving. Their losses are narrowing, but they also lost subscribers in the last quarter. So it's a bit of a mixed picture for Peloton. Sure, they don't want to bet their future still on just the hardware. They have been moving more and more into subscriptions, but that's still the big moneymaker. And I wonder if you're a consumer out there saying, I'm going to buy Peloton's products, are you going to ask whether it's safe now?
Yeah, I think a lot of people are questioning that. And they also had the issue with the bike pedals going back a couple years as well. So this is the fourth time that we have seen a safety issue come up with Peloton. We talk about the fact that their sales growth has been slowing now for quite some time. Barry McCarthy, Akiko, you just referenced the recent earnings report. He was saying that this quarter was already set up to be one of the most challenging here for the company ahead of this news today. So clearly it's going to be a tough couple of quarters here for Peloton. Lots are even questioning whether or not we're going to see a significant turnaround in this business, whether or not it could potentially be a takeover target by one of those larger companies that are looking for more of a footprint within the workout, within the homeware, home gym equipment space. So I don't know. We'll see. I think there's a lot of questions about the momentum that Peloton had during COVID and whether or not anything like that could be recreated going forward.
Yeah, the company has made it clear the turnaround is going to take a while. The question is, will investors stick around for that? All right, coming up, it is starting to get warmer out. That means summer travel season is coming. The CEO of Hyatt Hotels will tell us what he is expecting coming up on the other side of the break.
Hyatt Hotels holding its investor day today. Now, the company focusing on returning capital to shareholders by reinstating its quarterly dividend and raising its share buyback to $1.5 billion for 2023. Joining us now is Mark Hoplamazian, Hyatt Hotels CEO. Mark, it's great to see you again here. So first, just give us a sense of the demand that you're seeing now and why today was the right time to reinstate your dividend.
Well, Sean, it's great to be with you. And I'm joining you, by the way, from the beautiful Impression by Secrets and Secrets Moshe Resort in Riviera Maya, just north of Playa
It does
del
look
Carmen.
beautiful there, Mark. I'm jealous of your backdrop, I gotta say.
Well, come and visit soon. But this is where we held our investor days, you just said. And the fact is that, this recovery has been primarily leisure-led, but we're seeing steady demand increase in business travel and even more impressively in group demand, that is for larger groups, especially for corporations. And we're seeing really fantastic pacing for group bookings into next year. So things are clicking well across our key segments and across the globe. China's recovering as well. So we feel that this is, we're gaining more visibility further into the future with forward bookings. And we feel very confident in our cash flow generation. And so this was the right time to start returning more capital to shareholders.
Mark, it's an interesting contrast to some other names that we have heard in the travel space. Airbnb just a few days ago saying that they're starting to see travelers be a little more cost conscious. As you point out, you compete on the higher end. What are you seeing on that front in terms of how they're looking at the summer travel season, even given inflation?
Well, I would say that our demand has been sustained. And you're right, we do serve the higher end traveler. And so I wouldn't extrapolate what we're experiencing across the entire industry. I would also say that I'm actually sitting in one of our top tier of luxury in our all-inclusive portfolio, which is the Impression by Secrets brand. So we, the all-inclusive experience is actually at the other end of the spectrum from what Airbnb provides. So I think it's a very different value proposition for and experience for travelers, and more people want the certainty and the predictability with respect to what you pay for the all-inclusive holiday experience. So we're seeing great demand in the all-inclusive resort category and in our resorts generally speaking. So yes, we see sustained demand into the future.
Mark, so certainly the leisure traveler has been very, very strong, and that's been the case across the board. What about the business traveler? Because I was looking at your most recent results here. You're seeing about 85% of the levels that you saw pre-pandemic. Do you think we'll get back to 100%?
I do. Business travel's changed a bit in terms of purpose of visit. So what used to be strictly transient trips, like individual travelers traveling by themselves, in some cases has turned into groups of people from a given company traveling together. So that would be treated as a group, not a transient trip. So the line between transient and group has blurred a bit. So I think of it as commercial demand, like demand from corporations and from associations who are holding meetings. And I think that overall, what we will see is a full return of business travel broadly defined. What I would also say is that the quarter got better and better. So we did end the first quarter at about 85% of pre-pandemic levels, but it improved to the low 90s by April. So it continues to improve month over month, and we're seeing that momentum ahead.
You noted group travel within business travelers. We've also heard from companies themselves saying that they've learned over the years that you don't necessarily need to travel as often when we're talking about business travel specifically. To what extent are you able to make up some of that slack with those leisure travelers you alluded to earlier?
Actually, what you described is exactly what has happened. Leisure demand has filled in and we are well over indexed, I would say, in leisure. So we've seen leisure demand grow at a much faster pace than business travel. And overall, we are running ahead of 2019 levels as a whole company. And a lot of that has to do with the fact that we are serving more leisure guests in these days than we were back in 2019. So that substitution has occurred. It's also true that the shoulder periods in the week, which are Thursday night and Sunday night, which historically have always been the weakest nights for occupancy, have recovered much better than the midweek days of Monday night, Tuesday night, Wednesday night. And a lot of that has to do with the fact that a lot more people are taking long weekends and doing work, and also taking a break and having a vacation at the same time.
Mark, I was at Goldman's Industrial Conference yesterday, and there was a massive topic. It seemed like almost every single conversation that I had yesterday also involved AI. How do you see, or do you see AI playing into your business, and what does the timeline look like for that?
Well, AI is certainly playing a role in travel, first and foremost in travel distribution. I think the opportunity to allow individual guests to customize their searches based on their desires and certain keywords is significant, and we're already experimenting. We are taking it slowly because in some of the applications that we have in mind, there's data that would be important to provide and to churn through, and we still need to understand the environment in which that's going to happen in a protected way. So I do think that there are many, many applications, and some of that has to do with the way in which we actually go to market. I'll give you a very funny example, though. We just launched a new brand called Hyatt Studios, and we just used ChatGPT, and we said, if Hyatt were launching a new brand, and we described what the brand was, what color would the logo be? What color would be featured in the logo? And what it did was evaluate all the other logos that we have in our portfolio. They recommended a very specific shade of blue. In parallel, our agency selected that same exact shade of blue as their number one recommendation. Complete coincidence, but fascinating, right? And
did you guys go with it?
We did. Actually, the new logo, the core dark blue color that's in that logo is the same color that ChatGPT recommended to us. So in some ways, we were just having fun. We were just having fun to say, okay, what would it say? And lo and behold, our agency came up with the same color. So I think there are going to be many fun applications as well. That's just one example.
Certainly. And it also sounds like it could save you maybe a little bit of money on agency fees then going forward if it's able to make some of those critical decisions.
Yeah, maybe. The agency does some other things for us. So I think that's not going to be a complete substitute.
All right, Mark Hoplamazian, CEO of Hyatt Hotels. Thanks so much for joining us. Really appreciate it.
Thank you very much. Take care.
All right, well, coming up, Krispy Kreme releasing its first quarter results this morning. We will break down the latest from the donut giant's CEO. We'll hear from him on the other side of the break. Krispy Kreme reporting earnings before the bell this morning, beating on both the top and bottom lines. The company also reiterating its full year guidance, yet shares trading slightly lower, off just about 0.1%. We want to break it all down with Krispy Kreme CEO Mike Tattersfield. We also have Brooke DePalma joining the conversation. Mike, it's great to see you here. So strong quarter here from Krispy Kreme. You beat what the street was looking for. What's driving the momentum that you're seeing in your business?
Yeah, I mean, I appreciate having back on. So good afternoon. Hope you're all doing well. I think the main driver is what's been consistent since we transformed the company. It's really those 400 producing donut shops as we really expand, getting fresh donut distribution into what we call points of access. So the grocery trade, the convenience shop trade, starting in the club trade as well. And we do that in 31 countries. We just opened up the 32nd in Chile. So it's just you combine that, and then you can bring the premiumization of the donuts, and you bring that category where our biggest opportunity is, which is access. Get it to where customers are.
And you did raise prices here in the U.S. as well as in the U.K. Are you seeing any resistance there, or are customers trading down?
So we're a low frequency business. People come and shop at us about 3 times a year. It's primarily a dozens business. A lot of our customers use us for gifting, and all the dozens, about 80% are shared. So on average, it's still about a little over $1 a donut per dozen, right? So that opportunity is there. And when we premiumize and bring in whether a Biscoff cookie that we brought in January, or you have a Hershey's partnership, which we did across the globe, we really see a low elasticity on price. We have pricing power, but we're really thoughtful about it. We want to always remain a sweet, indulgent treat that's affordable.
Mike, are you seeing those pricing pressures, though, ease at all on the back end of things, the pricing that you guys have going into your goods?
So in terms of, the commodities or inflation, it's still mid double digits. We're hedged this year. We're starting to see some of that starting to slow down on the back end of the year. Sugar's still up pretty high, probably at some of its historical highs lately. So there's a challenge there, but the wheat and our other ingredients also are palm oil. So those are starting to come down slightly. So on average, those 3 make up 10% of our retail sales. So we can manage it. But again, we continue to look at how we get access to the customer. That's the thing that they don't get Krispy Kreme. It's tough for them to get it. So when you start to get to 12,000 locations over that in 32 countries, and you do it fresh every day, for a lot of them, that's the first time they get access to Krispy Kreme.
And one ways you're looking to bring Krispy Kreme donuts to customers is with your partnership, rather a test with McDonald's. What goals are you looking to meet in order to say, hey, this test is successful and we're going to roll it out nationally and globally?
Yeah, so I mean, when we started this going fresh, right, we were looking at what are the right channels we should be looking at. Clearly, the grocer and the convenience opportunity was there. And that's where we really started to push the business towards. We've been looking at club, the drug store business as well, and most recently in the QSR. And what it has to do is actually work with what our Delivered Fresh Daily program does as a channel, right? So it's got to work with the other channels so you can actually make the donuts fresh and then have a route system you can drop them off. And so when we tested with McDonald's in the latter part of last year in a 9-store test, we could see that the rigor and the drop and the quality matched. And then we moved on to the markets of Louisville and Lexington, which we've been in for 6 weeks. I was just also recently in the market. And it's really about seeing that, as a merchant, are you getting the right pack size? Is the freshness there? Are we delivering on time? What are the KPIs? And going through a pretty rigorous process, because channels and customers are going to have different, those customers are going to have different need states. Someone that's coming through in a drive-through that's looking for a coffee is probably going to do an individual serve. We really focus on dozens. So it's how do we make sure that works? And really getting the rigor of that tested gives us a lot of confidence that we can do it in the QSR industry. We are just doing this right now with McDonald's and both of us are learning. So we'll see where it goes. But we're pretty pleased with where we are right now.
And Mike, this morning you called it a donut logistics company. A lot of people thought that was pretty interesting. But I mean, your donuts are now in Walmart, you're in Publix, you're testing at Target and Albertsons, all fresh delivery daily. And so essentially when you look at that model, how do you make sure that you're ultimately making a profit at the end of the day?
So again, we look from this hub and spoke system, right? So our producing donut shops, right? They can go through the, they'll produce it at the shop. It can then be shipped through, one channel could be the grocer channel, then the route could also drop off at convenience. So we look at the profitability of the route. The donut maker that morning does not know where the donut's going. It could also be going through delivery and e-commerce. So when you look across it, that's how you can see the profitability of the business. If you look at where the margins have improved, particularly in the U.S. in the last quarter, a lot of that is because, again, the efficiency is you get the omni-channel approach. So that's how the business works. We've also seen in markets that, the U.S. started primarily as a donut shop business. So when we started to transform some of those shops to include the route system, their profitability improved dramatically, right? Because then you start to get the efficiency of what that producing shop can do.
Mike Tattersfield, thanks so much for joining us here at Yahoo Finance, CEO of Krispy Kreme. We hope you come back.
Pleasure,
Join
right?
us soon.
Thank you to all the Krispy Kremers out there. Tell Brian I said hello. All right.
We will, of course we will. We got to bring donuts next time.
He always wants me to talk about donuts. So we got a great, little mini Happy Mother's Day bouquet. Right.
Ooh.
So there we go.
I've got to tell my husband about that one. All right, Mike, thanks so much for joining us.
All good. Take care. Bye-bye.
Well, today officially marks the end of the COVID federal public health emergency. That means some COVID-related programs will be ending. Let's bring in Yahoo Finance's Anjali Kamlani. Anjali, there's a number of things over the last few years we've gotten used to, whether that's food assistance, free vaccines, but also telehealth and for some potential changes.
That's right, Akiko. So telehealth first, let's address that because we're actually getting an extension of the use of that, especially for Medicare members. The U.S. government has decided that because of the boost that it provided in terms of access to patients, including through audio only, that's going to extend through 2024. And then we also have separately prescription for controlled substances, think for maybe mental health visits and the like. That's going to extend for another 6 months until November 11th. And then any new relationships that have been cemented by then will get another year's grace period to get access to those prescriptions. And that comes after the DEA got a number of comments from the public asking for that to continue. Clearly some benefit there. As we all know, the telehealth industry really got a boost during the pandemic, lots of use. It has reduced in more of the general use area, but mental health has been one area that it seems to really be sticking. It's supposed to be a $50 billion industry by 2030. So no surprises there that there's some effort to keep it alive. Meanwhile, we do, of course, like you mentioned, free vaccines, free tests, all going away. Those are still in play just a little bit because the government has a stockpile of those items. So until that stockpile depletes, we will see that. After that, it will be up to commercial insurers and the like to see whether or not that will be available and covered. And one other change is that there was an expansion of those who could sign up for Medicaid, and those will now be moved since that ends today. Those individuals who were able to access Medicaid because of the extension will now be moved to the Affordable Care Act market. So all of that to say, lots of changes. And of course, we know the virus has not disappeared. We're still seeing tens of thousands of cases daily, as well as thousands of cases, hospitalizations and the like weekly. So definitely something to still keep an eye on, but lots of changes all in one day.
Yeah, important to note that you're right. It has not gone away, but a lot of changes in store there. Anjali Kamlani, thanks so much for that. Well, coming up, CEO Bob Iger taking aim at Florida Governor Ron DeSantis during the Disney earnings call. We're going to tell you about the latest jab in the Disney-DeSantis brawl on the other side of the break.
Watching shares of Disney under pressure on the heels of its second quarter results. The media giant reporting its Disney Plus streaming service lost 4 million paid subscribers. But CEO Bob Iger also making headlines during the call, taking aim at Florida Governor Ron DeSantis when he was asked about the parks business.
This is about one thing and one thing only, and that's retaliating against us for taking a position about pending legislation. Our primary goal has always been to be able to continue to do exactly what we've been doing there, which is investing in Florida. Does the state want us to invest more, employ more people, and pay more taxes, or not?
All right, we've got panel reaction here with our reporters Alexis Keenan and Alexandra Canal here to break it all down here. Allie, let's start with the business aspect of this, just what this means for Disney going forward, given the fact that this feud is not ending anytime soon.
Feud is not ending anytime soon. We're still very early days. It seems like investors, they have kind of shrug off this ongoing litigation, this ongoing legal battle at this point. That doesn't mean it's not going to ramp up over the next few months and the next few years. But just to reiterate why Bob Iger is speaking out about this is not the first time that we've heard him speak about this ongoing legal battle with DeSantis. He's clearly very comfortable at this point. You just heard a little bit of what he said on the earnings call, but on that call, he detailed specifically just how much Disney is investing in the state of Florida, $17 billion over the next 10 years at Walt Disney World. That will create 13,000 jobs. So he was telling investors he just doesn't understand why the state is making it that much more difficult for Disney to invest. He also said there's a false narrative being perpetuated that Disney is pursuing this litigation against DeSantis and that current board in order to protect tax breaks. He said on the call, quote, "We're the largest taxpayer in Central Florida, paying over $1.1 billion in state and local taxes last year alone. And we pay more taxes, specifically more real estate taxes, as a result of that special district." And as you heard from the call, he ultimately said this boils down to one thing and one thing only: the fact that DeSantis is retaliating against Disney due to the fact that they had an unfavorable response to the Parental Rights in Education Act.
Yeah, and retaliating against them and due to that pending legislation. So, Alexis, from the legal perspective, I think everyone is asking, how is this going to play out, or what happens next?
Yeah, so we're at the early stages, but it's complicated because there are two lawsuits here. There's both a state court filing and a federal court filing. You have Disney filing a federal case and DeSantis's camp, and that is this new board that is governing now the 25,000 acres that Walt Disney World sits on, as well as some of its subsidiaries. It's a board that is brought this case in state court. Now, the dispute is over kind of the same thing. They want control of this land, and Disney wants these contracts, these development contracts that it says it's put into place over the next 10 years to spend $17 billion, 13,000 jobs, they say. They want to control that. And so the mess here comes from the fact that these are dual sovereigns. You have a state government and a federal government, and they're both going to have courts, their own courts, decide these disputes. Now, we should expect both the board as well as Disney to ask these courts on the other side to pause them, put them aside until we have our dispute heard. But a federal court's not probably likely to grant that. So we could foresee a scenario where both of these cases move forward, and we could even see a scenario where both of these parties win their day. Now, that could be really problematic. And as one legal expert I was talking to today said, that's when all hell breaks loose.
He said that in that scenario?
Yeah, so a win for the Florida board, of course, would mean that the contracts that Disney tried to enter into to control this land would be invalidated. Then on the other hand, if you had a win for Disney, you would have those same exact contracts validated. So what you can expect, the moral of this story is expect a lot of appeals and expect this to go on for a long time if the parties can't agree.
Safe to say the two of you guys are going to be talking about this for many months to come. All right, Allie and Alexis, thanks so much for hopping on here. We are counting down to the closing bell on Wall Street. It's been a bit of a mixed picture here today. The Dow off just over 200 points. Nasdaq, though, holding on to gains. We'll be right back.
We are minutes away from the closing bell. Let's bring in Yahoo Finance's Inez Ferre to break down the market action today. And Inez, Disney, one of those big names dragging down the Dow.
Yeah, that's right. Disney is dragging on the Dow right now, and you can see on our Wi-Fi interactive board, we are set to end the Dow lower by 0.6%, the Nasdaq slightly higher, and the S&P 500 slightly lower. Now, what is keeping the Nasdaq up? Well, communication services, that is certainly keeping up the Nasdaq, because the Nasdaq 100, as you see right here, Alphabet up more than 4%, and in fact, Alphabet was up as much as 4.5%. 8% in 2 days, by the way. As you had mentioned, Disney is a laggard. I also want to point out what's been happening with the regional banks, because we have seen that PacWest has been leading the regional banks lower. And by the way, energy prices have also been lower today, as energy has been moving in tandem with the banks. Here's the closing bell at the New York Stock Exchange.
All right, that rounds out today's trading day. The Dow closing off just over 200 points in terms of the worst performers there. Energy, real estate, utilities, and materials all closing off by just about 1%. You're looking at communication services and tech and consumer discretionary as the outperformers for today. Nasdaq, the only of the three major averages closing to the upside, up just about 0.2%. Let's check in on one of the big stories of the day, and that's regional banks. PacWest shares plunging after reporting that deposits fell about 9% last week. We're looking at a loss of just about 22%. Western Alliance, on the other hand, saying that their deposits increased by $600 million to $49.4 billion for the week through Tuesday. And Nikiko, we were just talking to David Chiaverini of Wedbush last hour, and he was basically saying that it's two very different scenarios. When you take a look at Western Alliance, a company that he actually thinks could be an attractive buying opportunity, an attractive valuation right now, that the deposit flows there have stabilized and that they're trending in the right direction. Still, though, clearly a lot of fear about the next couple of months, next couple of weeks for PacWest.
Yeah, with PacWest, I mean, it's worth noting that those deposit declines that they talked about today, that was on May 4th and 5th. Remember, we were covering that when there were reports out there that they could potentially be exploring a sale. So, I mean, it's important to put that in perspective. Regardless of that, though, Shauna, as you say, just a lot of jitters around regional banks and where they are. That feels like we're starting to see a bit of a differentiation in the market right now. Peloton closing the day in the red after the company announced a recall for more than 2 million bikes in a joint release with the U.S. Consumer Product Safety Commission. Peloton says that, quote, the seat post can break unexpectedly during use, creating a potential fall and injury risk. A tough day, another tough day, I should say, Shauna, for Peloton as the company tries to steer this turnaround right now. Barry McCarthy was saying, as you point out just last week, that this current quarter will be among their toughest, and that was before this recall. So investors certainly concerned there. The stock down about 9%.
Yeah, investors very concerned, off about 40% in just the last month. This is bad timing. There's no way around it for Peloton, because given the demand trends that we've been seeing here for the company, for its products, that has yet to normalize when we compare it to the explosion that we saw for their products versus in the pandemic. So clearly bad timing there. Lots of wait and see just in terms of whether or not this turnaround strategy, if it's going to take a shape. We just heard in the recent earnings call that they are expecting it to be a rough quarter here for the company. Cash burn is still an issue. That's been an issue for Peloton, something that the street has taken issue with over the last couple of quarters. So again, this recall coming at a tough time, although when you compare it to what we saw in 2021 with the treadmills, it won't be maybe as big of a financial hit given the fact that they will just be replacing the seats and not the full bike this time.
And their losses have narrowed, right?
Yeah.
There's some positive in the results that we got from the company last year.
There is, yeah, there is. They have a ways to go, but they do seem to be slowly trending in the right direction if they're able to shake off tough headlines like today. All right, let's take a look at Goodyear Tire and Rubber Company. You're looking at gains of just about 21% after activist investor Elliott Management launching a new campaign against the storied tire maker, citing poor margin performance versus rivals, also weak board oversight of management and ill-timed tire distributions deals. Now, Elliott is pushing for a sale or other action on Goodyear's 1,000 plus retail stores. And you can see, obviously, investors a little bit encouraged by this, looking for a bit of a turnaround here from the company. Shares jumping today over 20%, Akiko.
Yeah, Shauna, and when you talk about the list of things that Elliott says needs to change, they believe that could bring the stock up to $32 a share. You look at where it's trading today, that's more than double. So certainly they see some significant upside. Elliott, of course, no stranger to some of these headlines in terms of, targeting companies. A few things I think to note. I mean, they've got a 10% stake in the company, so they are one of the largest shareholders. And they believe, to your point, that the company simply has been mismanaged right now. They want five additional directors on the board. We'll see if the company actually moves in that direction. Well, President Biden is set to meet with congressional leaders again on Friday in hopes of working out a deal on the debt ceiling. They want to avoid what happened in 2011 when Standard & Poor's downgraded the U.S.'s credit rating. It's been more than a decade, and other rating agencies haven't followed suit just yet. Yahoo Finance senior columnist Rick Newman is here. Rick, should we be concerned about a downgrade?
I think we should be concerned about a lot of different possible negative outcomes here. People who lived through the 2011 debt crisis showdown, and that did not get resolved until just hours before the Treasury Department was going to run short of money, will remember that when Standard & Poor's downgraded the U.S. credit rating, dropped it from AAA down by one notch, it felt cataclysmic. The S&P 500 sold off almost 7% in the first trading day after that happened. And that was after a sell-off leading into the debt ceiling fiasco back then. And at the time, S&P said, we're doing this, number one, because the U.S. debt system, debt situation is in bad shape. And number two, because of the political dysfunction in Washington. So how do things now compare to the way they were in 2011? The debt situation is way worse. I mean, we've seen no improvement in the debt whatsoever. Nobody has done a single thing to get this under control. So the debt was about $15 trillion back then. It's now $31 trillion. As a percentage of GDP, it's about 50% higher. And these trends are just going to continue. So the question is, could there be another credit rating cut if this does not get resolved in a timely way? Some analysts are saying, yes, it could happen. And some are even saying, yes, it should happen because the United States is just in a much worse fiscal situation than it was back then. Now, the credit rating agencies don't forecast what they're going to do. They don't like to give hints, but they are, they have issued some memos on the situation. They're very sober. They generally say, we assume that Congress will resolve this as it has done before. But if Congress doesn't resolve it, we're going to have to reconsider our position.
Okay, and we can read all about it in Rick's column on our site, yahoofinance.com. Thanks so much for that, Rick.
See ya.
Well, Elon Musk is back to tweeting. This time, he's got some news to share for the company. He's hired a CEO at Twitter. And here's specifically what he tweeted. He said he's excited to announce that I've hired a new CEO for X Twitter. She will be starting in 6 weeks. My role will transition to being X chair, executive chair, CTO, overseeing product, software. Shauna, we had kind of expected this. He had sort of signaled that he doesn't want to be a CEO forever. I do think it's interesting that he has said she, so we're talking about a woman CEO, female CEO, but I'm not going to start by talking about the list of issues that have materialized at Twitter. It's going to be a long show if we did that.
Yeah, it's going to be a tough job for whoever that she is that is taking over here for Elon Musk. I think there was a lot of doubt, Akiko, whether or not Musk was going to follow through with this before the end of the year, if in fact he was actually going to name somebody as CEO of the company. I was also just taking a look at what Tesla was doing after hours. Not a heck of a lot of reaction, but we know that the distraction that Twitter has been for Musk, that has been a threat, or investors have viewed that as a threat to Tesla here over the last several months. So it will be interesting to see exactly what this means for Tesla here going forward. But I'm a bit surprised by it that it came this quickly. I was expecting this maybe to not be announced until November, December, once we get towards the back half of the year. All right, well, coming
Tesla
up,
stock move force its hand is the question.
Yeah, exactly. All right, well, coming up, a recent survey from Bank of America is showing that the younger generations are eager to buy their first homes. But we're going to talk about what is stopping them now. We discuss on the other side of the break.
Well, mortgage rates edging lower for the second week in a row. The 30-year fixed rate mortgage averaged 6.35% in the week ending May 11th. That is down from 6.39 from a week ago. With rates remaining inflated, homeowners who may be looking to sell are staying locked into their lower rates, which is then creating low inventory of new home sales for sale. Does this mean it's a seller's market? Well, according to a new report from Bank of America, roughly 40% of those surveyed believe the current market could be in favor of those selling. For more on the real estate reality, let's bring in Matt Vernon, Bank of America head of retail lending. Matt, there's a line that really stood out to me here in the study. 69% of prospective homeowners plan to buy a home when it's right for them, regardless of price and interest rates. I'm curious about What percent of that number are actually first-time home buyers?
Yeah, roughly a third of our business today is in first-time home buyers. So I think that number is pretty astounding, the 69% in the market that we're in. And it just shows the resilience of the American consumer and the fact that the dream of home ownership still is alive and well, and disproportionately so we're seeing in the younger generations as well.
Matt, give us a sense of what the activity looks like today. Yes, we just did see the slight decline in rates on a weekly basis. Are you seeing more potential buyers coming off the sidelines yet?
We are, but I'd caveat that with saying the inventory challenges are still real. So while we have many borrowers that are interested in buying a home, that inventory challenges is making a little more difficult on them. That said, what we're hearing from consumers is they're ready to act when they find that home that becomes available. And to the earlier comment, even at the rates that we're at today. So they are, again, very, very resilient.
Specifically, you've been looking at numbers from Gen Z as well as millennials. I'm surprised that 56% of Gen Z say they plan to purchase a home in the next 2 years. What does that tell you, number one, about the savings, but also just how motivated they are, even in this higher rate environment?
It's really interesting. And it's kind of the opposite of what you may think with all of the challenges that are out there. But I think that sense of home, and compare that also with rental rates and the ability and the fact that those have continued to climb from a national perspective and regional perspective, I think they're making the smart decision to begin to think about how they pursue equity and a home of their own. And if they're going to ultimately spend what they're spending and they can buy a home to do that, they should go and do that route for sure.
Man, when it comes to when people are trying to figure out exactly what home they can afford, what are you seeing just in terms of the trends for down payments and how much people are willing to spend, I guess, reflecting that off of their income?
Yeah, the survey respondents said that they would be willing to put aside 25% of their income, which is relatively the same as what it has been in previous surveys. I would tell you that it's the borrower today is much more responsible in evaluating what they should afford versus what they could afford, meaning that they are focused not only on the housing payment, but all of the other ancillary costs that come with it to ensure that they're buying a home that they can ultimately stay in long term.
Where are you seeing the momentum right now? Is it still in some of these markets that really boomed at the height of the pandemic, whether it's Florida or Texas or Colorado, or are we starting to see other markets emerge now?
I'd say it's still heavy the Sun Belt states. Think about from Phoenix down and through Texas, and then over to the East Coast, over to the Charlotte area, and then down and through into Florida. Those are the primary markets that we're seeing the most aggressive growth in. You're seeing that from an inventory and price perspective as well, while the Northeast, Pacific Northwest, and some of the central states not nearly as aggressive, if you will.
Matt, do you think the worst of the housing slump that we've seen, is that behind us at this point?
So I think two things, right? One, we expect at this point that we've potentially reached a peak from a rate perspective and that we'll begin to see rates come down. So that's a positive through the end of the year and into next year, not precipitously, but slowly and gradually come down. So that's a positive. The challenge remains around inventory, though. We have way more borrowers that are out there. There's a stat around 3 million millennials who make over $150,000 that are looking to buy a home, and the inventory is just not there. So until that begins to solve itself, I think the market is still going to be incredibly competitive and challenging, but we will see the positives of rates coming down, so the affordability side will help.
Inventory is still a big X factor there. Matt Vernon, it's good to talk to you today. Bank of America head of retail lending. Well, coming up, it's been a crude awakening for oil and gas stocks this year, but with the declines we are seeing, is that opening up some investing opportunities? We're going to take a closer look next.
What a difference a year makes. Energy stocks were the top performer last year, but almost halfway through 2023, they're completely reversing course. So is there an opportunity at these levels? Let's talk about it with Rob Thummel-Tortis, a senior portfolio manager. Rob, it's great to see you again. So certainly was a high flyer last year. This year it has been under a tremendous amount of pressure. Do you think we'll see a recovery soon?
Well, I do. And I think for this reason, number one, the energy sector is really essential. We need a lot more energy, both domestically and globally, for the economies to continue to grow. And that's not going to change. It hasn't changed in decades, and it won't change for decades to come. But the number one fundamental reason why that the energy sector really is compelling and attractive to investors is there's a lot of cash flow from the sector. And so what that means for the sector is it's going to offer a lot of dividends and then also buybacks and stock buybacks. And so you got those two factors, visible cash flow in really uncertain times like we are in right now. That usually means that those type of sectors will do fairly well over the next several months.
Rob, let's talk about what the demand picture looks like right now for oil. We've heard over and over China, a potential big catalyst with their reopening. But you look at recent data, it does point to the fact that the ramp up has been slower than expected. What's the timeline you're looking at right now, and how much upside do you see, especially with some of these bigger oil names, as a result of that?
Yeah, so you've seen the oil markets trade off. Clearly, the oil price come down, the natural gas price come down. In the case of natural gas, quite substantially. The first quarter is always tough for oil markets because you've got a lot of refineries that are offline, so oil demand drops temporarily. The whole world is waiting on when does the Chinese economy reopen, and it's gradually reopening. And so we expect the demand for oil globally in China to grow and accelerate throughout the rest of this year. Currently, the global oil market is probably slightly oversupplied. It's going to flip to being undersupplied sometime in the late second quarter or early third quarter. And when that happens, you're going to see it when the oil market is undersupplied. Typically, you see a positive price response. So we would expect oil prices to rise a bit. And then how does that relate to the energy stocks themselves? If you look at Exxon, Chevron, typically they trade higher when oil prices go higher, and other energy stocks as well. So now with oil prices where they are, that's why we think at Tortoise it's an attractive time to be looking at the energy sector, because prices are probably low, they're probably going higher, and that will just result in an uplift of all energy stocks.
Rob, I think there's also a big debate going on right now just in terms of how much power OPEC has when you compare it historically speaking. And when you talk about the cuts that they announced, what that exactly means for the energy market. How big of an impact specifically do you see OPEC having on the energy market today?
Well, they still cover 40% of the market or something like that globally as far as production is concerned. And so, yeah, they still have a pretty significant piece of the market share. They have a lot of information with regards to demand, both domestically, but more importantly, globally in terms of where oil demand is. So they can make moves as they see it, probably with better available information than any of us. And so I think they still do have play an important role. The U.S. will continue to grow production. The U.S. is still important. The world still needs more U.S. energy, still needs more U.S. oil, still needs more U.S. natural gas, and that dynamic is not going to change anytime in the next decade and beyond. So the U.S. still plays a really important role.
Rob, let's talk a little bit more about clean energy stocks. We saw them rally in a big way on the back of the passage of the Inflation Reduction Act. Still a lot of assessment happening about to what extent that could be a further catalyst. But if we slice it between sort of solar, even hydrogen, what are you liking in that space? And is this actually a good time to get in right now?
Yeah, well, so the Tortoise, we look at kind of all of the above approach to decarbonization, right? The world needs to decarbonize. So solar's important, wind's important. And those are happening right now. In other words, the world's decarbonizing right now, using more solar and wind to generate electricity, using less coal. In the future, we think there's a lot of potential for things, as you mentioned, like hydrogen and carbon capture. That's important as well. What you need to help accelerate the growth in those areas are infrastructure. And you need more infrastructure and pipelines to be able to transfer the carbon, pipelines to transfer the hydrogen. So we think that's really important and critical in order to get the hydrogen and carbon capture even with the credits, more competitive. Biofuels are also interesting as well. If you look at what's going on with renewable natural gas and renewable fuels, basically creating transportation fuels where the raw material is not a fossil fuel. Instead, it's things like used cooking oil. That's really interesting to us as well. And so those are all opportunities for investors as we see over the next decade as well.
How do you play the space, though?
Well, yeah, that's a good question. Well, what I would say is, in a lot of ways, you can play it through some of the major indices or some of the ETFs that focus on solar or wind. Some of the specific companies. Well, big picture, Chevron and Exxon are doing a lot in this space as well, but obviously they're predominantly oil and gas companies. So you can play it through, frankly, Chevron and Exxon, because if any of this is going to accelerate, you're going to need Chevron and Exxon to participate. But if you want to play pure play, whether it's renewable fuels or biofuels or things like that, there are companies like Green Plains, which is an example of a company that's actually predominantly biofuels, specifically focused on some of the biofuels that are going to grow, like ethanol and ethanol production and things along those lines. There's obviously some pure plays on the hydrogen side as well. They're a little more startup at this point, and so from our perspective, we think probably the best way to play it is through the major energy players, because those are the companies that are going to benefit the most longer term and make the biggest difference.
All right, Rob Thummel, Tortoise Senior Portfolio Manager. Thanks so much. Well, coming up, more layoffs as Polestar is the latest to cut back. We will discuss what this means for the EV industry on the other side of the break. Job satisfaction now stands at a multi-decade high. That's according to new data from the Conference Board. So what's behind the jump in joy? Joining us now for a deep dive into the data is Yahoo Finance's Diane King-Hall. Diane, so what are we learning?
I mean, I love that we're talking about a jump in joy and more. People are more satisfied. In fact, workers are now the most content since the Conference Board started tracking job contentment in 1987. According to the Conference Board, job satisfaction rose to 62.3% in 2022. That's up 2% from a year earlier and a far cry from the lows of this survey back in 2010 when the job market was still recovering from the Great Recession. Now, fueling the increase, a tight labor market and flexible work arrangements. Measures that saw the greatest uptick, work-life balance and improvements in workload and the performance review process. Perks and pay improved with people reporting being happier with health plans, wages and bonuses, and the potential for future growth. Across the more than 24 metrics measured, hybrid workers were the most satisfied compared to fully remote or fully on-site workers. In fact, all sectors saw an increase in satisfaction.
It's worth noting that the survey was conducted before the most recent spate of layoffs that we've seen. So I'd be curious to see how that shifts. The hybrid work environment, Diane, though, is I think a really big one because I will tell you just from experience, just being in this office, you don't see workers in every day.
It's true.
But that flexibility, it feels like, is increasingly what's allowing companies to keep employees on board.
Right, and that is one thing that they noted. There's one of the things they noted in the survey was that this could shift when they do the survey again, because keep in mind, this is annual. This is a look back at 2022. And there was also a divergence in who was happier. Men were happier than women, signaling that pay and promotions were still a problem when it comes to the gender pay gap. You're looking at that gap in terms of the numbers between men and women, how they see different things like pay and other perks in general. So again, pay particularly a sticking point with women less satisfied with job characteristics like promotions, performance reviews, growth potential. And so you're seeing women, in terms of the data that they've conducted in this and a separate survey, more likely to quit their jobs than their male counterparts. So that was one interesting divergence. And again, kicking it forward to the future, we could certainly see some changes with how work dynamics are changing right now in terms of more companies calling back workers. But again, there's still been this push-pull with employers and employees in terms of coming back to the office and employers having to basically settle with continuing this really hybrid workforce, because the pandemic really changed how we work.
Yeah, the pandemic certainly has changed how we work and also what people are demanding, right? I think a lot of workers right now feel entitled. They think that they should still be able to work from home because simply they have been doing that over the last 3 years. I'm curious though how managers are looking at all of this data, right? Because there are a number of surveys that point to the exact opposite, that people are not satisfied because they're being asked to come into the office more often or because they're not given that flexibility that they did have during the pandemic.
Exactly. So some of the metrics that were measured in this could certainly change as they conduct this for 2023, or certain responses to the areas that were measured in this, such as just happiness with work-life balance, performance responses from, say, managers, because managers may have different views on the hybrid work arrangement. But again, it still remains something that's really kind of part of the makeup of how corporations are still operating. Sure, again, managers such as the banks and whatnot want people back in, but look, we've talked about New York City office foot traffic. We talked about that recently. It's still below or just above 50% of what it was pre-pandemic. So I don't know.
But I like the fact that at least this survey, it was
happy.
Before the most recent job cuts, but people were happy at one time. All
right. Let's focus on the positive.
Diane King-Hall, thanks so much.
You got it.
Well, job satisfaction may be at a 36-year high, but the job cuts are continuing. EV maker Polestar, just the latest to announce it's eliminating 10% of its workforce. The firm attributed the cuts to delayed production for its Polestar 3 and a tough economic environment. Meanwhile, Microsoft says the company will not provide or will not raise a full-time employees or raises for full-time employees this year. The tech giant slashed 10,000 jobs under 5% of its workforce in January in an effort to reduce costs as revenue growth slows. Shauna, I think it's worth differentiating all these. We tend to kind of lump in all the cuts and say it's the macro environment. EV names specifically, though, are really, really struggling in some way. I mean, Polestar just the latest. Rivian's had cuts. You've had Lucid announce cuts. Even the legacy names like GM and Ford have had cuts. And this is really kind of an industry that's in transition, trying to find its footing, improve productivity. But also, we've seen the stock down, questions about how quickly the demand will, or how stable the demand will be. And then, of course, the price cuts that we've been talking about.
Yeah, exactly. And I think it's putting a lot of pressure on a number of these smaller makers. But actually, I guess you're also having GM was also offering a number of its employees buyouts as well. So I think the shift here to the EV space, which we know is more expensive, at least right now, to produce these types of vehicles, profit margins are under pressure. So a lot of these companies are having to adjust. Some of these smaller companies like Polestar that was already having production issues is obviously being forced to lay off employees just to survive in this environment. And then when we shift over to what we're seeing in the tech sector, Kiko, obviously a little bit different here because many of these companies scaled astronomically during the pandemic. They were hiring tens of thousands of employees. There are numbers of employees that make up their workforce today, clearly double in some cases to what we had back in 2019. So they're needing to adjust to this new normal as we do move away from the pandemic. But when you take a look at these layoff numbers, 270,000 tech jobs have been cut on a global basis in the last 6 months. That's the latest data out from layoffs.com. Intel was also out saying that they are cutting workers earlier this week. Reuters was reporting that Intel had already cut employee and executive pay earlier this year to try to get costs under control. So clearly, we're seeing pressure across sectors and management facing these tough decisions. They need to lay off workers in order to better position their company for profits here in the second half of the year.
Well, and Shauna, how many of those cuts have been followed by announcements from these companies who say, we just grew too quickly during the pandemic. We thought that demand would continue. Now, Microsoft, I would argue, is more one of those legacy names. They've obviously built out a pretty healthy balance sheet, but they've even talked about the demand, especially the investment on the tech side, on their cloud side. Some of that's starting to wane as well because companies are turning a lot more cautious. So on the one hand, you could say some of these companies, the tech companies, especially the startups, grew too quickly. But at the same time, they are feeling the pressure of the broader macro environment. And that, I would argue, is a bit different than what we're seeing on the EV side of things. Well, AI is playing a big role in Facebook and Instagram's future. Meta is using artificial intelligence daily in a variety of ways, including in news feeds, for ad targeting, and removing what it considers harmful content. Meta's head of global business group, Nicola Mendelsohn, spoke with Yahoo Finance's Ali Garfinkel about that and a lot more at the 2023 Milken Conference here in Los Angeles.
There's so many things when I think back over the last quarter, but it's actually a result of all the hard work that all the teams have been putting in over the recent months. Particularly starts with the size of the community. So the community now is 3.8 billion people that are coming on every month, and 3 billion people are coming onto one of our platforms every single day. So that's the highest that we've ever seen. And if I break down just some of those numbers a bit further, and I think about something like Facebook in the US, we're now seeing 200 million people coming on every single day. That's the largest it's ever been. So I think it starts with the growth of the community. And then I think that's backed up in turn by how we're seeing the advertising revenues, which it's been our highest Q1 ever.
And I want to actually hit on those advertising numbers because, you know, across the sector, we saw Alphabet, Roku, Snap say digital advertising is still suffering, but Meta's cooking. So where does that gulf come from?
Look, there's still a lot of competition out there, right? And so we have to work really hard for every dollar, pound, euro, cent that is out there. But what advertisers are telling me and coming to me and talking about is the fact that they see us as being absolutely key to helping their businesses grow and helping them reach the consumers that matter. And they want to know from us, what are the new products? And we've got a lot of new products that I'm really excited about that I think have in part contributed to that growth.
And tell me, what are you hearing from advertisers right now? Because the narrative is that they've pulled back.
So what I'm hearing is that there's a stability out there when it comes to how they're seeing things now. So we've gone through a real period of real fluctuation, lots of changes that people couldn't have envisaged. But I think people are now more comfortable and confident in terms of what those uncertainties are, and they're factoring them in. So I think that's how we get to a period almost of normalization of the disruption and a more of a stable environment to be in.
And then in terms of products that advertisers are excited about right now, what are kind of some of those flagship products that you guys are really talking about?
Oh, we have a few. So I would be remiss if I didn't talk about Reels. It's one of our fastest growing products. And what we saw just in the last handful of months was a doubling of the amount of Reels being shared every day to 2 billion Reels being shared. And that's people commenting and sharing and discussing and debating and really enjoying the content that they're seeing. And a lot of that's been powered by the investments that we've been making in artificial intelligence and machine learning. So that's one. That's a really exciting one. The second one is around messaging. And we have with WhatsApp and Instagram Direct and also Messenger as well, 3 really exciting messaging platforms for advertisers to be able to reach people in new and different and varied ways. And we're seeing that one of the products that we have that we call Click To actually enables advertisers to start a conversation in one of the individual threads. That now has a run rate of $10 billion. Yeah, and I travel a lot with my role. It's a global role, and I've been in Brazil, I've been in Singapore, I've been in India, I've been in Korea, and it's been really interesting to see some of the use cases that we're seeing there with some of the large businesses and advertisers. One of which was Geomart, where they've basically built a whole supermarket with 20,000 SKUs right in WhatsApp, where a person can go in, can pick the groceries, can arrange the delivery and the payment, all within the individual thread, and then of course do the same thing again next week. So it's really exciting to see the growth of some of those products. And then finally, we are here at Milk and everybody's talking about AI here, right? So we launched last August a whole suite of AI-powered products called our Advantage Plus products. And this is really helping advertisers to get the performance that they want with a reduction in the cost to actually reach the people that matter to them. And these are different products that we've got across the way in which to reach people, the way in which to measure, and the types of creative that advertisers can put out there. And they do a number of different things, but ultimately it's about giving that strong ROI and reducing the amount of manual steps that it takes for a person to put a campaign on our platform. So this is the beginning of a really exciting journey for us in this area.
And how would you distill it down if you had to, what Meta's role in the AI landscape really is right now?
So this is not a new area for us. I mean, we've been working with AI since really back to 2006 with the introduction of feed. And we use it in 3 different ways. So we use it to surface and bubble up in the feeds the best content for you, that individual of those 3.8 billion people, to see the things that matter most to you. So that's where we start. We also use it to take away off the platform any type of harmful content, misinformation. We're doing that through machine learning and AI. And then finally, from the advertising side and the monetization of our products, then it really is about making sure that we put the right products in front of the right people at the right time. So those are the different ways that we're using it today.
And of course, cost cutting has been a big story at Meta. So I was curious, given the layoffs, how are you feeling about the trajectory of the company?
Yeah, so look, layoffs are never an easy thing for any company to do, and we're seeing it right across, well, not just the tech company, but across business per se at the moment. But in terms of how I feel about the company, I feel very excited. I feel very excited about the North Star vision that Mark is putting out there, the bets that he's placing, everything from, well, all the things that we've spoken about, but I would also be remiss if I didn't also talk about the worlds of AR and VR and the bets that we're placing to the metaverse. I think there's very few CEOs that are bold enough and brave enough to put a bet on something that could be 5 and 10 years out. And so I feel very excited of how that community will move through the different phases that we've seen of digital to be where we are today to ultimately where we'll all be in some type of virtual reality experience as well in the future also. So yeah, I feel very excited.
This gets me to the second to last thing I wanted to ask you. Meta in 5 years, how will it be different and why?
Wow, so that's such a hard thing to ask anybody in a tech company. I think 5 years back, could I imagine we'd be talking about the things that we're talking about now? Probably not. Although the clues are in some of the things that I shared just at the end, which is I do and feel very excited about the prospect of virtual reality and the impact it's going to have on our lives when it comes to all aspects of our lives, from how our children are going to be educated. And it's been wonderful to see younger members of my family put on and travel to places that they've never been to, having a deep sea dive experience, climbing Machu Picchu from the living room at home, right? I mean, I think that's amazing, and that's what we can do today. I think about how it's going to change the way in which we collaborate and ideate in the world of work, and then also in the way that people will be able to socialize. I think about things like pop concerts or football matches always the preserve of the very few, now being able to be opened up to so many more people to have those sorts of experience. And of course, the whole environment that new jobs are going to be created for individuals, for creators, for people with followers, types of jobs that we cannot even imagine yet. And one of my favorite new jobs that I'm hearing about is a digital avatar stylist. Now, we're seeing already that there are 1 billion downloads of different
Is that a growth industry?
It's a new role. And again, who knew that is? So that's what we already are seeing today. Who knows where those sorts of new jobs and opportunities are going to come in the future.
And last question that I wanted to hit with you. On a personal note, you were diagnosed with cancer in 2016. 2019, you founded the Follicular Lymphoma Foundation, and then COVID hit. So I'm curious, what is your view on leadership in times of uncertainty that's coming from all sides?
Yeah, so thank you for giving me the opportunity to talk about that. Getting a diagnosis like that is just, it's a real moment, and it's something, that can rock not just you, but your family and your friends around you. But I did set up a foundation. This is an incurable disease that I live with. And I think what I've learned through all of this is to not be afraid to be vulnerable. If you're vulnerable, people will be vulnerable back. But I think it's also important to give people hope. I'm absolutely determined to find a cure for this cancer. And if there is anybody out there that wants to go on a journey with me on this, I've found people at Milken to be unbelievably helpful here. And I am all in, and I want to hear from you. But I think it's about, yes, and acknowledge the difficulties that you're in, but also make sure to paint the North Star and the horizon of where you are going to get to. My horizon, I'm going to find a cure for this disease.
And our thanks to Meta's Nicola Mendelsohn and Yahoo Finance's Ali Garfinkel there. Well, coming up, we're going to take a look at a few stocks trending after hours. Stick around. Well, Social Security experts are already forecasting the cost of living adjustment for 2024. Yahoo Finance reporter Carrie Hannon is here with the very latest. And Carrie, what kind of adjustments can seniors expect?
Exactly. As inflation has started to cool, this number's coming down. And the first estimate out of the gate is from the Senior Citizens League, and it could be as much as half of what last year's was. They're calling for a 3.1% increase versus the 8.7 we saw this year. Now, it's early in the game. You got to realize this is truly crystal balling it, because how the COLA, the cost of living increase, is calculated is from the Consumer Price Index. They take July, August, and September. They average them together and they compare it to last year's to come up with the figure, which will be announced in mid-October. So we're early to the game, but it's worth noting that it will be less this year, and it's something that seniors will need to prepare for, because something like half of all seniors, retirees depend on, or I should say half of their income depends on Social Security. So it's something that they need to plan for.
And Carrie, we've started to see inflation moderate, but if we're talking about a 3.1% adjustment, would that be enough for more seniors?
Yeah, that's a great question. And the Senior Citizens League has talked to some of their seniors, done a survey on this. And in fact, people are already worried this year that the 8.7%, which roughly came to about $140 extra each month in their checks, is not enough, that it's not keeping up with what their actual costs are this year. So there is this concern that more than half of the retirees they spoke to are feeling that they're already spending above that. But you need to remember what happens is, it's kind of funny the way this consumer price index that they use to calculate it, because it's not based on what a retiree over 62 spends. And so what the Senior Citizens League found is that, in fact, it calculates for a very small percentage of someone's budget in that index. Maybe 6% is for healthcare costs, when in fact, most retirees that they, in their survey, about 29%, they said most of them, 29% of their budget went to healthcare, not that 6%. So there is a disconnect here, which is why it can be a little squishy and how it actually can help a retiree. So again, all these numbers are early on, but it's worth taking note of that. It's important that, yes, it is adjusted for inflation. This is a great thing about Social Security, but it may not be enough for some.
So, Carrie, you just talked about how that's not necessarily an accurate picture of sort of expenses when you're talking about senior citizens. Does that suggest the inflationary pressures are greater than the data suggests?
Yeah, I mean, it depends, but there are different spending patterns. For example, as we talked about, healthcare costs may be more, food costs may be more than what the index is based on somebody who is currently still working. So there's a little bit of a disconnect of what retirees spend on that makes it difficult. But again, when you are on a fixed income and there is any inflationary pressure, it is concerning, because that is what you have. So, right now, as we saw this year, as I mentioned, it was $140 a month increase. That was great. But again, inflation continued. So they're still feeling the heat of that. And moving forward, with a reduced number at 3.1% perhaps next year, they're still carrying the weight of the inflation that they've had last year and this year.
Yahoo Finance's Carrie Hannon, thanks so much for bringing us that story. Well, let's head over to Shauna now, who's been watching some stocks trending after hours. What do you got?
All right, Akiko, we've got two names for you here, News Corp and Getty Images. Let's kick it off with News Corp, because we're looking at gains in extended trading of just about 5.5%. The company beating the street's estimates on both the top and bottom line. News Corp also saying that its cost reduction measures, which does include a headcount reduction of about 5%, they now expect that to yield about $160 million in annualized savings. So we're looking at a pop here of just about 5%. But on a year-over-year basis, yes, those numbers did beat what the street was looking for, but revenue has declined from a year ago, off just about 1.8%. Also, its news media ad revenue decreasing $11 million, or about 5% from a year ago. Year to date, you look at losses of just about 8%. Switching it over to Getty Images, that stock off just about 1.5% here in extended trading. A mixed report from the company. EPS did miss. Revenue coming in better than expected. Free cash flow, $16.4 million. But let's take a look at a 2-month chart of Getty, because you can certainly see the pop in the stock here, up just about 25%. The big reason for that was the fact that the company is under activist investor pressure here from Trillium Capital. Trillium urging the company to explore strategic options, including a sale. We'll hear whether or not we'll get any more information on that on the earnings call tonight here. But again, stock under pressure in after hours trading over the last 2 months, up 25%. Year to date, looking at gains of just about 12%.
Shauna, we've got some developments coming out of Washington, D.C. here on a topic we've been talking about a lot, which is the debt ceiling. President Biden's debt ceiling meeting that was scheduled for Friday has now been postponed. He will now meet with congressional leaders next week. All of this, of course, comes after the president met with Senators Mitch McConnell, Chuck Schumer, House Speaker Kevin McCarthy, and House Minority Leader Hakeem Jeffries earlier this week. Reports say the delay is happening because negotiations at the staff level are still ongoing. And of course, we've been watching that June 1st ex-date that, as Treasury Secretary Janet Yellen has alluded to. Well, coming up, we recap the top stories from the day. We'll be right back. It is closing time here at Yahoo Finance. Let's get you caught up on some of the biggest headlines of the day. First up, more regional bank concerns. Shares of PacWest plummeted after the bank reported that deposits fell 9.5% last week. The company says, though, that most of that drop occurred after media reports that the bank had been weighing a sale or capital raise.
Activist investor Elliott Management is pushing for changes at Goodyear. Among the changes Elliott wants are a revamped board and for the company to find ways to better monetize its stores. In a statement, Goodyear is saying that they are, quote, reviewing Elliott's recommendations. Goodyear shares popped on the news, rising 21%.
And finally, Peloton is issuing a recall for more than 2 million of its original bikes. In a joint release with the U.S. Consumer Product Safety Commission, Peloton says that the seat post can break unexpectedly during use, creating a potential fall and injury risk. Peloton shares getting hit on the back of that, ending the day 9% lower.
All right, well, that'll do it for us today on Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern Time. Have a great afternoon. We'll see you then.